that's Welspun Corp. It is in focus on the back of Q4 numbers. Margin contracted both yearly and sequentially, while the net profit grew 20%, aided by lower finance costs and taxes and also by higher other income. Vipul Mathur, the Managing Director and CEO of the company, is joining us now to explain what led to this fall in margins and what is the outlook going forward as well. Mr. Mathur, good afternoon. Thank you so much for joining us today. The street is disappointed with the margin fall that has come by. Can you explain what led to this margin fall? Were there any one-offs in this particular quarter?
Very good afternoon. And it catches everyone by surprise when market reacts like this. But nevertheless, if you look at the Welspun Corp earning, I think so it has been a sort of a historic performance. It has, in terms of its revenue and in terms of its EBITDA and in terms of ROCE, I think so. If you see the FY24 number, it has been one of the best performance or the best performance ever given by Welspun Corp. Q4 has been a little muted, and as I said, see, we are into a project business. Number one, the quarter earnings depend on the product mix what we have. So in some quarters you have a nice blend of orders, and some quarters you have a little lesser margin blend of orders. I think so that gets impacted on a quarter-on-quarter basis. But as I have always said, that this is a company to be looked on, on a year-on-year basis. And if you look at our FY24 performance, I think so it has been a very spectacular performance.
Okay, if you could give us a sense of why the margins were impacted in Q4, and does that rebound as far as the first quarter of FY25 is concerned?
See, the margins in FY24 primarily was impacted because of the blend, as I said. The type of orders, the blend of orders, what we were executing in FY24, in the fourth quarter of FY24, were primarily the more water orders, and it has a little less blend of oil and gas, number one. Number two, our US business also we had taken a sort of a capital maintenance shutdown there for 1 month before we restart for a major order out there. So these two things put together, I think so this it's a one-off impact in a Q4. I think so if you see from an order book perspective, if you see from the growth, all the geographies where we are present and what type of order books what we have and what type of momentum we are seeing across all the geographies, I think so this is we are going to recover from this. So it is a sort of a one-off, I would like to say that.
Okay, so you call it a one-off, but the other thing that the street is worried about, Mr. Mathur, is that since you're so confident, you're still talking about revenues of 17,000 crore rupees in FY25, which is actually a slight dip if we say on a YY basis.
Sorry, because I lost your voice, please.
The other thing that the street is a little worried about is the guidance for FY25. 17,000 crore rupees of revenues and 1,700 crore rupees in terms of EBITDA. This is actually slightly lower than revenues that you did in FY24. Can you explain the reason? Are you just being a little conservative, or is the market challenging?
No. If you see, we jumped from 10,000 crore rupees revenue to 17,000 crore rupees from FY23 to FY24. If you see, we jumped from an EBITDA of 800 crore rupees to 1,800 crore rupees EBITDA. Or, when we gave the guidance, we gave a guidance of 15,000 crore rupees and 1,500 crore rupees EBITDA. Right? As as you get into the year, there are things which keeps on changing. It's a dynamic world; it keeps on changing. And what we promise, we deliver. So at this point in time, at the start of the year, we have given a guidance. I think so. We are seeing robustness across all our businesses, and I'm sure that it is only going to be improving from here and not going down. So it's a mere guidance what we have given. It doesn't mean that it has no potential to get improved from here. And FY24 results are a testimony to that.
So you are saying that there is a possibility you will be able to surpass this guidance. I'm asking again because while you're saying everything is robust, demand is looking good, Q4 was led by some one-offs, the US business shutdown and the product mix change. If that improves, will it not improve revenues? Despite the fact that 17,000 crore rupees you're saying is a record number, will you not grow on that in FY25?
See, it may. I mean, it may grow. There's no doubt about it. The margins will improve. I am very confident of that. One thing is very important is the play of our US business has to come in, and it is going to come back in the third quarter. It is going to come back there, and that is where you would see even the revenue started going up. So the impact of that you will see in Q1 or Q2 of the next years. But in terms of margins are definitely going to improve as what we have committed at, or what we have indicated at this point.
Mr. Mathur, one question. You spoke about the US business. there seems to be a little bit of lack of clarity currently as far as the carbon capture project. So is that the project that you're saying will come on stream as far as Q3 or Q4 of FY25 is concerned? There has been no update. You said that there had been a delay in the order for 6 months, but I think the last couple of years there hasn't been an update on that.
No, carbon capture project is under repair. So that I'm not talking about that particular project. I'm talking about.
Could you give some clarity on that particular project itself?
Yeah, so that project is under hold at this point in time. There are land acquisitions issues which are there with the E&P company which is going to do that. And we have already notified that there is a suspension which is now in place, and so it is not going to happen. Let's be clear that whether this project is going to happen at this point in time, the answer is no. But what I am banking on is the Permians. As I said, Permian is the mainstay of US LNG exports. We have been one of the largest players in the Permian basin. Out of the 4 or 5 pipelines, what has happened there in the Permian basin, the gas coming to the Gulf Coast, we have supplied, more than 2/3 of those pipelines. And we have just concluded on 31st of March this year, we have just concluded a large order from the Permian. And now there are another pipelines which is under discussion. Those pipelines will happen, sometimes in the third quarter, end of second quarter, start of third quarter.
What would the size, Mr. Mathur, what would the size of this particular contract or the project be, the Permian project?
It would be almost similar, if not more. Similar to the last one. These Permian pipelines are almost close to 350, 400,000 tons of business. And if you see historically, we have been doing that on a year-on-year basis. So it's a sort of a momentary blip which has come in. When I say blip, it doesn't mean that we do not have a business. We are still booked till Q3 of this year. So there is a business continuity. What we are talking about here is the business beyond Q3. And I am more than confident that, this Permian business is going to come up, is going to get finalized. And we are one of the largest player, one of the most, in the pole position. And I am sure we will definitely be in contention there. And we are actually.
Okay.
Good to hear that, sir. So give us a sense of the visibility as far as the DI pipes segment in Middle East is concerned. We understand that you're expanding there with a capex of close to 500 crores in the next couple of years. This is, we understand, in competition to Jindal Stahl, who's an established player there already. When will your facility come online in the next couple of years? Can we expect to see some revenues from there?
So we have just announced that. I think so it will take at least 18 months for us before we come absolutely online. I think so the market is a very mature market. The market is quite significant. I think so it has a play for every player at this point in time. We did a complete due diligence, and we definitely see that there is a gap for one potential player to come up and put in there, and that is what we have done. And I am very sure that this investment is going to be a very, very productive investment once it comes on stream. It's a very, very due diligence we have done it, and it's a very, very promising market. We all know that.
Okay, all right. Mr. Mathur, let's talk about how much did Sintex also contribute. It has seen a strong growth in FY24. Revenues have grown by 23% on a YY basis. What is the trajectory for next few years? What would the revenue margins and capex in this particular business look like?
So Sintex is absolutely, if you see, we have just been in 1 year into the business, and they have been doing exceedingly well. They did a top line of almost 635, 23% YoY margin. I think so they're absolutely on track, number one. It has a strong brand record. It has, we are rejuvenating this dealers and the distribution network. There's an extensive work which is being done at this point in time, and we are seeing the results of that coming in. As regards the capex, we have already announced that we will be doing a capex of almost 2,300 crore rupees into this entity, and that capex will be spread over the next 2 years' time. And this capex is primarily across all the pipe segments and also a bit on the water segment side of it, the tank segment side of it. And those facilities will start coming on stream maybe at the end of this year or the early next year, and then we will start seeing their contribution into our EBITDA market. Just to remind.
So just one question. You spoke about capex. Could you give us your outlook on debt, and also if you could quantify by the end of FY25, how do you see your order book shape up? In the call you did mention that you're expecting 2 to 3 large orders. Could you quantify the order inflow? The end of FY25, what will be the order book, and how do you see debt trend?
So, just to answer the order inflow, let's talk of US. I think so. We are, as I said, we have an confirmed order book of Q3, And then we are banking on this new Permian order, and in which we are a pole position. And I have no doubt whatsoever that we would be the selected one there. Number one. Number two, when we come to, let's say, Saudi, our Saudi business, we are the largest, we are the controlling interest there, we are in the driving seat there, and at this point in time, we have almost 2 years of a confirmed order book. So that entity is completely booked for 2 years, and the Saudi market is growing significantly. We all know that, and that is why we are also investing into DIPs and all that stuff. Now let's come to India. I think so. In India, we have almost an order book of 500,000 tons at this point in time. And it's a project business. We are at this point in time bidding for various international and domestic projects, both in oil and gas and water. But we already have a head start of close to 500,000 tons. It will only go from here. Now let's talk of DIP. Now DIP is, in India DIP, which is currently operational. We did almost 200,000 tons of DIP. In the very first year of our operation, we delivered 200,000 tons. And we expect to, and this year, we expect to reach almost 70 to 75, 80% of our capacity utilization. So I think we are not deprived of order, number one. The market across all the segments are saying, we are seeing a tailwind. And I'm sure if we do things correctly as what we are intending to do, I am sure order is not going to stand in our way.
Okay. And sir, the outlook on debt?
As regards debt, I think so. We started FY23 with a debt of 1,138 crore rupees, the net debt. You see, we have been able to bring it down to 300 or some 80 odd crore rupees. We have been able to do that for two reasons. Number one, the financial prudence, and all the businesses have been generating sufficient cash flows. So we have been able to maintain that. Now, even with the capex, what we intend to do over the next 2 years, all our businesses are free cash flow businesses. They will generate sufficient cash flow. So it is not going to create any sort of a debt pressure onto my balance sheet. Broadly, what we are looking is at a debt to EBITDA ratio, maybe less than half a percent.
Okay.
Right, sir. Right. Thank you so much, sir. We've run out of time for this particular interview, but we'll get you once again very soon, as a lot of those orders do come in. Let's now slip into a short break. When we return, we will be joined by the management of Crystal Integrated Services to discuss the quarter gone by. Stay tuned.